Look, I'm here today to talk about MAA. This is a really exciting REIT. It is one of the A- credit rated REITs. So it's got a long history. It's got a powerful dividend track record. So one of the big questions that I want to ask today is whether or not this is a buy. We can see from the credit rating, it is currently a strong REIT. It's got some good opportunities. And so today, in this video, we are going to look a little bit at the history. We're going to look at the price to the current AFFO, which is kind of like looking at the price to earnings multiple to see whether or not it's undervalued or overvalued. We're also going to look at things such as their overall profile, as well as their development pipeline to see what the future holds for this REIT. We're also going to look at some of those analyst targets as well as present some estimates of the fair value to try and understand what type of upside we have for this REIT. Stick with me to the end to find out my overall summary of the opportunities within this REIT today. For MAA, here is a recent presentation that I think provides quite a lot of insight. They do highlight their consistent strong performance to shareholders. For example, the annual common dividend per share has been increasing quite strongly, particularly in recent years. In addition to this, they've got a very steady core FFO per share growth as well that we can also see since the pandemic has been increasing very strongly. They've also compared themselves to their peers here, and you can see that they've also generally performed better than their peers in terms of the total annual compounded total shareholder return here, which is consistently above their peer group. One of the very nice things about MAA is because of the size and the particular geographies, they have a good spread here over the Sun Belt in the USA. They have a reasonable diversification in terms of asset types and asset classes, as well as a reasonable diversification within the submarkets of interest. One of the other important elements is the ongoing continued development that they use to unlock value for their shareholders. Now we can begin to see here they have a good development pipeline. We have expected initial occupancy here through 2023, one project here in 2024 and one in 2025. And from this as well, we can see over these years another 2,300 total units. And when we begin to look at their overall development expectations as well, they've got further expected starts here from 2023 through to 2026. So a reasonable pipeline here that looks like it's going to deliver another 3,300 units over the next 3 years. Now it's really important to note here as well that they're one of only 8 public REITs that are A- rated or above, with a recent upgrade from Moody's. It's also useful to note that they have a well-laddered debt with manageable maturities in 2023 and 2024. Now, switching to the next slide, we actually begin to see this, and there's a couple of really important points here as well. Number one, they have a weighted average interest rate of only 3.4%, and this is entirely fixed. So it means that if rates were to increase, if rates were to go bonkers, it means that it doesn't hurt them because of the use of fixed rates. Now, as we can see here, the debt maturity profile is really important to look at. Now, it does show that they have about 8, 9 and 9% debt maturing over the next several years, but they've got on average quite a nice spread and quite a nice consistent maturing of this debt that will enable them to continue to pay this effectively. Also, when we begin to look at some of their credit metrics, one of the metrics I do like to look at here is the core FFO payout ratio, which is looking at about 61%. And so they've got, in my mind, quite a strong balance sheet indeed. First of all, I want to have a quick snapshot of what Mid-America Apartment Communities is looking like. So for this, as always, I like to turn to fast graphs. Now I've switched this over to the price to AFFO. Now here in orange we have 15 times price to AFFO, but historically, because of the premium valuation, MAA has traded at about 18.5 times on a P to AFFO ratio. Now at the moment we can see here in black it is trading pretty much bang on that valuation. So you could say on the weight here that it is fairly valued. Now it does have an S&P credit rating of A-. It is a 16 billion market cap company, and it's got a reasonable long-term debt to capital ratio of 38%. Now it's also important to look at the analyst scorecard down here. Now looking at this row here, for example, it's 100% of the time the analysts are getting it right 1 year ahead in their predictions of what the AFFO is going to come in at, and 2 years in advance they get it right 92% of the time. So in other words, we've got a fairly stable, easy to predict AFFO for this organisation. Now I'm going to switch over to the fast graphs calculator here to begin to understand what the forecast looks like and what this means. As I suggested, it's pretty much trading at a fair value here. Now in the last 5 years it has traded at 20.9 times. I'm going to bring this up to about 17 years of about 18.63. As I said, I think this is fairly reasonable. And if we take that, what it's traded at over the long term, we might say that the total annualized rate of return is about 9.9, 10% annualized rate of return. Now, what this means is it means that on top of the 3.88% dividend yield, we're getting about 8% annualized rate of return here in the AFFO for 2023, another 2% in 2024, and another 6% in 2025. Now, if we look at the analyst estimates down here, over the last 6 months, the estimates appear to have changed a little bit, deteriorated slightly, but not substantially. So they're fairly stable, and in my mind, that is definitely a good thing. So the total annualized rate of return then is only about 10% per year, at about 25% overall. It has a reasonable dividend yield. Now what I'm going to do now is I'm going to switch to a couple of other tools as well to try and get a better fix on whether or not this is a good time to buy. Now I've switched over to Koifin. One thing I want to look at is the way in which the ratings from the analysts have changed over the last several years. And we've got this average analyst rating here decreasing from close to 4, which would have been a buy, down to on average close to a 3, which is closer to a hold. We can see here as well that of the 19 analysts covering MAA, about 11 of them hit this as a hold. So on average, a reasonable buy at this price. Now also when we begin to look at the historical price target, obviously when times are good, the price is more or less hitting that white price target there. When times began to turn a little bit worse, we can see the prices have declined, and of course the price targets have declined along with those prices in general, and we can see here that from the current price of $1.44 up to the average analyst target of about $1.68 would provide some good upside. Still on Koifin, what I've done is I wanted to have a quick look at some of the key solvency metrics for this real estate investment trust, this REIT. One of these is the interest rate coverage, and if we begin to look at EBITDA divided by the interest rate expenses, we can see that on average they have a very high level of coverage there. Now we can see that as well as we begin to look at the total debt to EBITDA. We can see that as we look at the total debt to equity as well, it's rolling at a fairly reasonable view, and of course total liabilities to total assets as well, running at about this 44%, down from about 54% in 2015. So at this point, they're looking fairly solvent. Looking at the enterprise value, probably one of the metrics here that I think is going to be most relevant is this enterprise value to sales. We can see that this is now at about 10 times, and that's decreased very much from that peak in 2022 of 17 times. And we can see this enterprise to sales is at a low level that we've seen in about 2018 and 2016 as well, suggesting that this could be a reasonable time for us to look at making an entry point. Now, one of the elements of Finbox that I do is the presentation of the estimates here. Now I've just done a quick check there. We can see from the contributing estimate counts that if we're looking at AFFO, most of the estimates don't go beyond the 3 years forward. So I'm just going to cut this down to 3 years forward. Now when we begin to look at the AFFO forecast estimates, what I want is this average estimate. Now, the current year then looks like it's going to be boosted up, with forecasts increasing here in the +1 year, +2 year, and a reasonable increase there in the +4 year, which is also what we saw from fast graphs as well, with some reasonable AFFO forecasts coming up ahead as well. Now, I've switched over to Finbox as well to get a little bit more insight from this platform. So looking at Finbox, the financial health is recommended as overall great, good cash flow health, good growth health, good profit health. Now, what I've done is I've taken off some of the models that it runs here. I'm not too worried about the dividends, multi-stage dividends, stable growth. I've found that those aren't going to work particularly well for the REITs in this particular instance. Now, as we saw, the analyst target of about 168 is higher than the current share price. We saw that as well from the Koifin platform. Now, if we begin to look at these financial models, though, that I've used here, we've got an estimated fair value of $159 compared to the $144 current share price, which suggests that there is about a 10% upside. Now, this is not a strong upside, but this is an A- rated company. It is a company as well that has some very good potential. Now, I've switched over to Koifin again, and I just want to have a look at some of the macroeconomic data here. So obviously in blue here we have the core inflation rate in the USA, which, as we know, after the COVID-19 pandemic has jumped up to about 6% and has been decreasing now down to about just under 5%. Now, on top of that, I also want to look at the rental vacancy rate across the entire United States. Now, this has also been decreasing quite a bit down to a low here of about 5.8%. from a high here of about 11%. So that's going to be putting pressure on the market. That's going to be putting pressure on the vacancies, and it changes the balance of power in the negotiation for rent. Now, that is going to be favourable with a low level of vacancy. It means there's going to be more competition for those apartments that MAA has, and that should be working to keep the rental prices high for MAA. So, looking at this, yes, a good REIT. Yes, a good investment. At the current price, I would say it is more or less perfectly valued. It is not an investment that I think I'll be making myself right now and adding to my family's portfolio. There is definitely upside. There is definitely some good dividends there. They have a strong pipeline also of future property developments, which is absolutely good to see. However, I think at this price, only a reasonable opportunity, and I think there's some other really good opportunities out there in the market that are slightly better than this and are a better fit for my family at this point in time. Now, I'm always keen to hear what you think. Let me know in the comments down below, is this on your radar, and at what point maybe would you be interested in buying into this fabulous REIT?